I think that the big buyers of the week were the Chinese. I think the Chinese were able to take advantage of the fact that the market sold off on the news that they weren't buying gold in May to buy a bunch of it in June. And in fact, they're probably going to end up buying more gold in June than they would have bought in May. But because they announced that they didn't buy, they created a sell-off, which they were then able to take advantage of. Now, whether they were smart enough to figure that out in advance, to think, hey, why don't we just stop buying for a month, and then we can tell the markets that we didn't buy, and then the markets will jump to the wrong conclusion that we're done buying, and then we can really step it up.
China has unexpectedly paused its vigorous gold buying spree after an intense 18-month period, resulting in a noticeable dip in gold prices this week. As the world's largest gold buyer, China's sudden decision to halt purchases has sent significant ripples through the precious metals market, highlighting its substantial influence on global gold dynamics. Throughout 2023, the People's Bank of China, PBOC, led all other central banks in gold acquisitions, boosting its reserves to over 2,000 tons. This strategic move was part of a broader effort to reduce reliance on the US dollar and strengthen economic stability. Chinese consumers echoed this trend by investing heavily in gold coins, bars, and jewelry. These purchases were seen as a safeguard against the volatility in Chinese stocks, currency, and real estate markets, which have been under significant pressure. Recent data, however, indicates that China has temporarily halted its gold buying spree. This sudden policy shift has surprised many investors, yet is not without precedent. Famous analyst Peter Schiff asserts that historically, China has demonstrated a tactical approach to market dynamics, often pausing to reassess and capitalize on more favorable conditions. This strategic pause is likely an attempt to take advantage of lower prices, ensuring maximum value from their investments. Interestingly, even without Chinese buying, gold prices have recently hit new highs, suggesting other market factors and buyers also play crucial roles. On Friday, gold prices saw a modest rise, recovering within a consolidation range after a sharp drop on June 7th. This indicates that the demand for gold remains robust, supported by various global economic factors. Moreover, central banks in emerging markets are ramping up their gold reserves to hedge against the expected devaluation of fiat currencies, especially the US dollar. They are shifting from paper currencies to tangible assets like gold. Peter notes this trend marks a strategic shift in reserve management, emphasizing a preference for assets that maintain value during economic instability. We will present clips from Peter Schiff's interview. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
This week, gold was up, and it finished the week strong, up almost $30 today. We closed at 2,334-ish on the day. It wasn't as big an up day as Friday last week was a down day, but because we moved up for most of the week, we ended up recovering all of last week's losses and then some, because between the 2 weeks, gold is actually positive. And the fact that gold was able to rise 2% this week in the face of not only a less dovish Powell, but also a strong dollar. The dollar index got hit pretty hard on the week. Let me pull it up. The dollar index closed at 104.8 last week, and it closed this week at 105.5. So about a 75 basis point move up in the dollar. Yet despite the strength in the dollar, we saw strength in gold. But even though we had that strength in gold and silver, by the way, although silver was not able to recover the $30 mark, it was still up on the week, and it closed at $29.63. Figure that out in advance to think, hey, why don't we just stop buying for a month, and then we can tell the markets that we didn't buy, and then the markets will jump to the wrong conclusion that we're done buying, and then we can really step it up. Because I think that the Chinese wanted to back off a little bit. I mean, they've been buying for so many months, and all of a sudden gold spikes up to a record high. It makes sense that they'd want to just back away a little bit. and let the market breathe, let it pull back, and then resume their buying. Contrary to the way the markets reacted to this news, I think it's very good news that gold made a new high rather, without the Chinese buying. Because a lot of people thought, well, maybe it's only China, right? China is the driver of this rally. They're just one of the buyers, because even though China didn't buy at all, we still made new all-time record highs. And so I took that as a bullish indicator, not a bearish indicator. But one of the reasons I think that you saw such a strong gold market during this past week is because the Chinese resumed their buying. But it's not just the Chinese that are buying, it's all these emerging market central banks that are buying, because they understand what's going to happen with the US dollar. They understand what's going to happen with fiat currencies in general. And so they want to do what they can to diversify their reserves out of paper into real money. And so they're buying gold. And of course, the most over-owned fiat currency, the fiat currency that represents the lion's share of reserves, are US dollars. And so to the extent that foreign central banks are going to buy are going to buy gold, they're going to pay for it disproportionately with US dollars, which is why ultimately the dollar has the most to lose. And in fact, since the dollar just rose against other fiat currencies, that gives the Chinese an even greater incentive to use those dollars to buy gold.
The Federal Reserve opted to maintain interest rates on Wednesday, while hinting at the possibility of a single rate cut later this year. Their cautious stance is due to persistent inflation, which has proven higher and more enduring than initially anticipated. Policymakers await clearer signs that inflation is reaching its 2% target before committing to any reductions. However, the Fed's inclination towards rate cuts isn't indicative of a triumph over inflation, but rather a response to the economy's substantial debt burden. The U.S. government's staggering $35 trillion national debt and corporate America's facing significant debt maturities make current interest rates unsustainable. Peter believes that to avert a financial crisis, the Fed must reduce rates. However, before doing so, they need to convince the market that inflation is sufficiently under control to justify such cuts. This requires maintaining the impression of restrictive rates, even though rates have never truly been restrictive. He criticizes the Fed's prior actions, arguing they have not adequately addressed inflation concerns. If the Fed genuinely aimed to bring inflation down to 2%, Peter argues they would raise rates rather than pause. The prolonged period of near-zero rates has significantly contributed to the current inflationary pressures, thus creating the perception that inflation is managed, even if through maintaining a facade of restrictive rates, becomes crucial for the Fed's next moves.
The Fed is really looking for is an excuse to do what it needs to do anyway, which is to cut interest rates. In fact, as I mentioned on the last podcast, the Canadian Central Bank, the European Central Bank, they've already cut interest rates, even though inflation remains well above their so-called 2% target. The same thing is true with the U.S. But I think what the Fed is trying to do is to maintain a pretense. The Fed wants to fool the markets. That's the game plan, into thinking that they're very vigilant on inflation. So they don't want to fold quickly and cut rates. They want the markets to believe that the Fed is being extra cautious to make sure that by the time they cut rates, that they're confident that inflation is going back down to 2%, because they know they're going to cut rates, not because they've won the battle against inflation, but because they've lost. They have to concede, surrender, but they can't admit that. They need to cut rates because rates are too high for a low, overly leveraged economy to bear. Not just the government, which has a $35 trillion national debt, but corporate America. Is a lot of debt that U.S. corporations took out years ago that is going to be maturing and that needs to be refinanced in 2025 and 2026. And companies can't afford to refinance that debt. Banks are in a lot of trouble because of the mortgage debt that they own and the treasuries that they own. So the Federal Reserve knows that in order to keep this financial house of cards from imploding, it has to cut rates. But it can't cut rates unless it convinces the market that it's already, beaten inflation. It has to create the perception that the rate cuts are justified. And so it has to pretend that it's holding rates at a restrictive level long enough to be certain that inflation is coming down. But all of this is a ruse because rates are not restrictive. They've never even moved into restrictive territory. I've argued this the entire time. Everything that Powell said during the press conference and in their official statement is wrong with respect to the Fed's commitment to bring inflation back down to 2%. If the Fed really was committed to doing that, it would be increasing interest rates. It wouldn't have stopped hiking them. In fact, if the Fed really cared about inflation, it wouldn't have lowered rates to zero and kept them there as long as they did. Powell mentioned that inflation is creating an economic hardship, which is true. Well, if that is the case, why did the Fed wait so long to raise interest rates? Why did the Fed deliberately allow that hardship to get worse before it took any action? In fact, when the Fed saw that inflation moved above 2%, it didn't immediately raise rates. In fact, it didn't raise rates before inflation got to 2%. The way it's saying it wants to cut rates before it gets down to 2%. See, when inflation was below 2%, the Fed was willing to give inflation a lot of slack. The Fed was reluctant to be preemptive about preventing inflation from rising above 2%. But now it's saying we don't have to wait for inflation.
Gold is currently navigating mixed pressures. Positive US jobs data and reduced Chinese buying weigh on prices, while geopolitical tensions and potential central bank purchases offer support. If China resumes its gold buying spree, it could provide additional upward momentum for gold prices, potentially pushing them towards higher resistance levels. Share your thoughts on Peter's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.